Welcome to Hedge Fund Premium's HedgeCast, weekly video overviews of trends, news, and events.
Hello, this is Richard Wilson, and welcome to this week's HedgeCast. Today we just have a few quick news stories to cover, some updates from the last time we created a HedgeCast for you. First, Luxembourg is becoming another hotspot in Europe. In the past, we reported that many funds are moving from London and England over to Switzerland, but Luxembourg is another hotspot where funds are relocating. This is mostly because of regulations they have in place, strong investor protections in Luxembourg, and probably most importantly, just a really strong multilingual workforce there, which can really help on the investor relations side or in operations. If you have an international hedge fund, then it could make a lot of sense to be based in Luxembourg. Also, it's just a really convenient place to travel from. It's kind of like having your hedge fund based in Chicago. A little bit easier to get to investors in all places than it would be if you're based in, say, London. Next is there's an article that came out in Bloomberg from Matthew Lin on the right time to start a hedge fund. And within his article, he said there's really three reasons why right now is a great time to start a hedge fund. The first was that right now the equity markets are low, so if you start your fund now, you're more likely to get those increased returns, which are going to get you the performance fees for your hedge fund. Next, he said that the carry trade is back. Between the currency differences, there's more money you can borrow in one market and employ that within another market. And third, asset bubbles, he believes, are popping up all over the place because so many governments are pumping money into the economy. So things like gold, equities, real estate in certain places are being boosted by that excess cash, which is trying to be pumped into the system. So I actually agree with him. I think it's a great time to start a hedge fund. Obviously, it depends on your strategy, but it always is best to start a fund when asset prices are below average. And right now, a lot of things have been knocked down before below their true long-term value. And a lot of people I've spoken to have a lot of experience, have a decent amount of capital among them and their peers they work with and their friends in the business. And right now, if they can't find a good job on Wall Street working for an investment bank or a hedge fund, why not start their own fund, get the 3 to 5 year track record in place, build a great team with other talented professionals who may have some capital and not a job anymore. And it could be as a great time for all of that to come together, because the biggest, most important thing for any hedge fund, small or large, I believe, is the pedigree of the team and the talent on the team. And so right now there's just like an excess of talent. There might not be an excess of new capital to raise, but hedge funds are raising capital, as we'll see later in our report today. And there's probably more talent available now than ever before. Next is a jury has acquitted two Bear Stearns hedge fund managers today. They were accused of misleading investors about the subprime mortgage meltdown and financial crisis, supposedly costing investors over $1.5 billion. The main issue is whether they were trying to pump new money into these investments while they really knew they were going downhill and misleading investors, or whether they're just trying to market and do their job, market the fund they were in charge of marketing. But they were acquitted just recently. Next, hedge fund performance in October slightly fell last month. Inflows were $14.2 billion to the positive in October, so hedge funds did raise assets, and overall hedge fund assets have increased 1.8% in 2009 for this year. The total hedge fund assets for right now across the whole industry is estimated to be $1.96 trillion, almost $2 trillion now. Another report came out recently, which I thought was rather interesting, is that of all the money that banks have had to raise this year in 2009, 40% of that money came from hedge fund managers. And as I was talking earlier about when's a good time to start a hedge fund, when asset prices are below average or below their long-term true value, I believe that hedge funds will be very well positioned in the future, because the financial sector and banking sector has been hit harder than any other area. And as those areas recover and then perform and hopefully overperform. That means these hedge fund managers are going to perform and overperform and over the long run. And so I think this is very good for the hedge fund industry. It's a great sign that a lot of hedge funds have taken advantage and gotten in on that low-priced asset. And I think it's just one of the results of having a very nimble entrepreneurial industry. These managers are mostly very highly compensated if they do well, and not compensated hardly at all relatively if they do poorly. And so they're very quick to take advantage of opportunities where other large banks or financial institutions might take 9 months or a year and a half to do due diligence on an opportunity to invest in a bank, or they may just say, we don't want to take that risk. And hedge fund managers have obviously been there providing 40% of the capital. So thank you for joining us today, and next week we'll be back with another HedgeCast. Thanks.